Welcome to the Inside Housing Podcast, where we break down the housing process, real estate, and investing. Here we go. All right, Brian, welcome
Rennick.
to Inside Housing Vermont. Appreciate you making it out.
Thanks for having me.
Absolutely. So I kind of tracked you down a little bit. I heard a lot about you from fellow agents, and your name was referenced quite often when it came to mortgage lending. So why don't you introduce yourself?
Sure. Yeah, so my name's Brian Vaughan. I am co-manager of the Vaughan McHenry Team at Fairway Home Mortgage. We are located in Burlington. Our office is in the Maltex building on Pine Street, downtown. And I have been with Fairway for early 2021 is when I started. The backstory is I started as a loan processor before making my way through to my current role. Prior to that, I was with Wells Fargo. That was my first job in the mortgage industry.
And you have to give me your NMLS number.
Yes, 204-6057 is my
go.
NMLS ID.
So how long has that been? How many years
Yeah.
is that in mortgage lending, loan
Yeah.
origination, all that stuff?
So me getting into the mortgage industry was a COVID-related job change, like so many people, right?
Okay.
It was, at the time, my wife and I were living in Iowa. I grew up in Connecticut. We met in New York City. We moved to Iowa because her parents lived there. So we were there, wound up being about 7 years. We had moved in 2015. We had never really felt like the Midwest or Iowa was home. We always wanted to move back to the East Coast. We just didn't really know how we were going to do that financially or practically. So what happened was we got married. We had a kid. We bought a house. We had another kid on the way. And we were like, okay, life is happening. And we are quickly kind of setting down roots here, kind of whether we like it or not.
So the kids came when you were in Vermont.
No, 2 kids were born in Iowa and 2 more were born in Vermont. I have 4
Gotcha.
kids total. So I was working in the restaurant industry out there at the time, and then COVID, and so everything shut down, and was just looking for what I could do to pay the bills in the meantime. And Wells Fargo has a big headquarters right outside of Des Moines. We lived in Des Moines, and I knew some people who worked there. So they helped me format my resume. They're like, if you just do it this way, it picks up all the things that, the screening, I don't know, AI screening. This is the way to get your foot in the door, get your resume noticed. And so they helped me out. I got it formatted. I got a handful of kind of calls from different departments that I just clicked down the list to submit for these different positions that were available. And mortgage loan processor was like the first one that kind of felt like, oh, okay, this is great. This does what I needed to do. Wells Fargo, early on in the pandemic, they sent everybody home. So for me, I had 1 young child at home. My wife we had our second at that time. So she would have been a 3-year-old and a 6-month-old. So I just didn't want to be around people early in the pandemic. Didn't really know what the deal was. So you
just kind of fell into it. That's become a new career. And
Correct.
It seems like you have a pretty big passion now for helping Vermonters, everything to making things affordable and all that. So now you're in the world. It's like, what is that, 6 years now in the lending world? You're quite well known. And so where does somebody start when they're thinking about Vermont and affordability, and from your lens, because you're putting a lot of information out there, where do we start? How do we make things make sense?
Yeah. You mean from an affordability standpoint, just like
Affordability.
where you start with buying a house? Yeah, this is such a cliched thing to say, but you really do need to start by talking to a mortgage lender. And the reason is because there's so much information out there, right? You can watch a bunch of videos on Instagram, you can YouTube stuff, you can Google stuff, you can use Google's AI summaries, you can ask ChatGPT, and that's all going to provide you varying levels of quality information, varying from absolutely zero quality up to pretty good quality. And it depends on how you phrase questions and all that. But at the end of the day, there's so much nuance to mortgage underwriting requirements and guidelines that if you don't know the right questions to ask yourself, you're never going to be able to answer those questions for yourself about your specific circumstances. So really, step number 1, you should contact a mortgage lender.
And can you define it? I'm a realtor, right? I run a real estate brokerage, and I still see that a lot of people don't even understand the role of the mortgage broker. So right down to the basics, what is the role? Because a lot of people are thinking, yeah, I'll just click on a rock and more kind of thing and just get pre-approved, and I'm good to go. And I can do that. I understand my finances.
So high level, obviously, the mortgage lender's role is to provide the money you need to buy the house. Most of the money you need to buy the house, right? That is the fundamental function of the mortgage lender in the home buying process. If you just keep it at that definition, there's thousands upon thousands of lenders out there who can provide money for you to buy a house. But that is not what the service of mortgage lending really is. The service of mortgage lending is ensuring that you are set up with the financial structure, the loan profile and structure that is right for your circumstances, and that you understand why that is that way. That is a much different proposition than simply asking somebody to give you a couple $100,000 and having them write you a check.
That makes a lot of sense. What are the things that you're seeing a lot right now? Because affordability question is just everywhere. It's the basis sometimes for the podcast, which is housing seems to many to just be out of reach or unaffordable, or it doesn't make sense. Where do you start with that particular demographic?
So for me personally, if I'm having a new client call, when we first meet a new client, they've submitted an application, we're going to get on the phone, or I like to do a Zoom call to be able to review the info on the application with them, make sure I totally understand their circumstances, which goes beyond just the information on the application. Some of that is critically relevant for mortgage financing purposes. Some of it is just important so that I have context for their life and their goals and their needs, because there could be things that work for them, structures that work from them from a mortgage qualifying standpoint. But like I said, it's not in line with what they want or need for where they are in life. The things that I always start with when it comes to folks who, for one reason or another, maybe there's some challenges around their ability to afford a house, is, okay, first I need to understand, where are you right now, right? We need to get to the point of you feeling comfortable really sharing with me, what is the full scope of your financial picture? If the answer is, I got $500 in the bank and that's it, okay, that's fine, right? We have had folks buy houses who have $500 in the bank, but we can't get anywhere to putting together an actual plan for somebody until we understand where they're starting from. So that's number one. We just get on the phone together, get on a Zoom call together, review that information so that I understand everything about them. Then, on my end, there's all this background work that's going to happen. Looking at mortgage underwriting guidelines, seeing how their specific circumstances line up with this, reviewing all the kind of if-thens that go along with certain qualifying criteria for folks so that I can then pull out, hey, from my review and from what I know about your circumstances, this is what I think the best path forward for you is. And then also, there may be another path B, path C, and we're going to talk about those in a follow-up conversation. But this is what I think fits best. Here's a pre-approval. Tell me what you think. Let's schedule another time to talk and review all these options so we can make sure that you totally understand what I'm saying to you here as far as what would need to happen to get you into a house.
All right, so you've worked through the initial conversation. You've figured out the different paths. And then what are you seeing out there right now? Like real time 2026, it's August 2026. What are you seeing that's working and not working? Because we're seeing the math not make sense for a lot of people right now, especially on the buy side. I feel like lending in particular leans into the buy side. What are you seeing there?
Yeah. So first off, in the market in general, it obviously depends on exactly what we're talking about. But one thing that is happening is homes are sitting for longer. They are not going as fast as they have even last year. There's more inventory on the market, and that inventory is sticking around for longer. What that means is home values are not appreciating as fast. Sellers are forced into a position of being more amenable to what we would call concessions. Now, that can come in a lot of different forms. Is that agreeing to certain inspections? Is that agreeing to a reduction in the purchase price? Is that agreeing to providing a seller credit as opposed to a reduction in purchase price? So the point is, I do see that there's a lot of opportunity, and a lot of folks we've been working with have been taking advantage of the fact that this is the market right now. Some homes are not doing that.
So I really feel like it depends on the area, because you're trying to find the buying power, but you're also trying to give them the range and the flexibility of like where that works.
And so I think when it comes to, if it is a question of affordability for somebody, then definitely one of the number one questions is just like, where are you looking to buy a house? And if that is in an area that is more highly competitive, then some suggestions around maybe a broadening of search parameters is necessary. You got to look a little bit further out from where you maybe ideally would want to be to find the house that you can afford, and just having that candid conversation up front. Then, if it's a question of having the funds available for the purchase, and or a question of the monthly payment just feeling like it's not where they need it to be for them to keep living comfortably, they don't want to become house poor, then it's talking specific strategies around specific properties with the real estate agent and the client to figure out how we can best structure an offer so that we can at least get as close to that goal as possible for them. What does that mean? We're going to look at the difference between offering a lower purchase price versus requesting a seller credit, or some combination of those two things.
Do you find a lot of people understand what the seller credits are?
I need to explain it usually to make sure that it's fully understood. So obviously, to compare it to, the most obvious thing I think people think of is when getting a deal on a house is a reduction in the price. I'm going to get the house for less than it's listed for. And when you do that, then everything kind of drops down proportionally, because everything's based off percentages, right? You're doing 3% down payment or 5% down payment or 10% down payment, whatever it is. So you keep the percentage the same, then it's going to just drop down proportionally based off of the reduction in that price. So it's going to reduce your cash to close in that way. It's going to reduce your monthly payment in that way because the loan amount is going to be smaller. On the flip side, if you're doing a seller credit instead, let's just say it's a $10,000 reduction in purchase price versus a $10,000 seller credit. The seller credit is the seller is crediting directly to the buyer at closing funds that they otherwise would be receiving from the sale of their home. So let's say they were going to receive $300,000 from the sale of their home. If they're going to credit you $10,000, then they're giving you $10,000 that it functions as cash at closing to credit towards the money you have to bring to closing.
And the key to that, because I see it on the real estate side, is that the house has to appraise.
Yes.
I remember back in the height of 2022 and 23, when we were having multiple offers sitting on houses and the values were just going up and up. I had one particular instance where we put in an offer $150,000 over asking price. And I think fortunately we didn't get it, because one of the things I had to explain to the buyers was you're going to be underwater in terms of equity, and that's cash that you bring. So you're also having that conversation too about like, where does it appraise, and if it doesn't, which then gets into if the house potentially is sitting there a little bit time and there's flexibility in terms of the price, then it's a good time to get that seller credit.
Yeah, this is where that strategy with the real estate agent very much involved in these conversations on a property-specific basis really matters, because it's all going to be dependent on the context of that property. Like you said, if it's a place that's been sitting for 5 months and they're having a hard time moving it, it's had 3 price reductions, okay, we probably are in a position to maybe ask, just go in at that price with a seller concession or offer whatever. The specifics of that would be what we would talk about. By the same token, if it's a newly listed house that's been listed for 7 days and there's a lot of activity, we might not be able to get a seller credit based off the asking price, but could we offer over asking with a seller credit so that the seller's still going to net what they want, their asking price, but you now as the buyer are getting that cash credit directly to the money that you need to bring to closing. That's the situation in particular where you really got to be talking about appraised values. If you've got a house that's listed for $400,000 and you go in offering 415 with a $15,000 seller credit, if it appraises at 400, now you've lost that.
And are you kind of with that? Are you seeing that more people are needing that help with cash right now? Because it kind of ties back to the affordability conversation.
Yeah.
And I feel like there's a mix in Vermont, right? Because you do have some who can come in with cash, can come in and just have completely different loan structures.
Yeah.
But for those who are trying to figure out the affordability piece, are you seeing that we need a little bit more help with cash? Or is it ultimately whatever makes the monthly payment make sense?
I would say between those two, cash is the bigger consideration, is the one that comes up more frequently. It's hard for me to say if that is universal. That may just be more specific to the clients that I've been working with. I don't know if that can be projected out to what the market is like in general. But I think that makes sense to me, because the cash out of your pocket is the immediate pain of closing on a house, right? That's the money that's going to go out the door right at closing, versus the monthly payment. Okay, if it's a difference of $100 in monthly payment, that's a little bit more spread out, feels a little more abstract. It's more in the future kind of thing. I think it's easier to digest that than a difference of $15,000 at closing. That's obviously a big hit, and for some people, that's everything. It means everything, and is the difference between being able to buy the house and not.
So the name of the show is Inside Housing Vermont. Are there programs that most Vermonters are not aware of that can help them get to, mainly for first-time home buyers, that can help them get into houses that they may not be aware of?
So the best program that we use very frequently that is specific to the state of Vermont is through the Vermont Housing Finance Agency, or VHFA for short. Those are state-specific programs that they're technically affordable housing programs. They have a couple of different options available to folks. I find that many first-time home buyers are aware of these programs, because what do? As a first-time home buyer, they start to just Google first-time home buyer programs Vermont. But a lot of times what folks don't realize is that those programs are actually not just for first-time home buyers. You can be somebody who's owned a home before and still use some aspect of the VHFA program. Now, they have down payment assistance programs as some of the programs that VHFA offers, so money that they would give you to close on the house. To use those, you must have never owned real estate before. But you can use some of the other programs, which can give you a break on interest rate and a break on Vermont property transfer tax, if you are not a first-time home buyer.
So let me make sure I understand that for somebody listening.
Yeah.
So the VHFA program is not necessarily for first-time home buyers. Inside of that program are like different buckets that if you've never owned real estate, you can be entitled to a certain amount of money to help. But there's other things that if you have owned real estate and it's your second or third purchase, you can still benefit from. My understanding of it is that it has a lot to do with the amount of money down that you need versus a conventional loan type, where typically you're looking at, because a lot of people assume, I need 20% down on a home. That's kind of floated around in media in general. You watch a TV show and they're like, I have to save $100,000 to buy a house. But these programs allow you to get in with usually 3.5%, 5% sometimes.
Yeah, so that's not specific to the VHFA programs. So just big picture, the minimum down payment requirement to buy a primary residence is anywhere between typically 3.5% and 5%. There are loan programs that allow you to do 100% financing, and those are like a VA loan or USDA loan. So that's even an option. But most commonly what we're seeing is folks using conventional loans or FHA loans, and those are 3.5 or 3 to 5% as the minimum required down payment for those. So separate from VHFA entirely.
Okay.
VHFA loan programs, they do allow you to do that. So you can still do as low as 3 to 5% down as a first-time home buyer. But what they are is they're called bond loan programs.
What do you mean by bond loan?
So bond, the way I like to describe it is because they bond with a primary mortgage. So you're going to use VHFA with conventional or VHFA with FHA. You're still getting a 30-year fixed-rate mortgage, and it's a conventional loan or an FHA loan. So there's an underlying base mortgage program there that you're pairing with the VHFA program. The added component to the VHFA piece is that because it is an affordable housing program, it is technically a program that is subsidized by the federal government, which allows for lenders who offer them to provide lower than market interest rates per the specific requirements of the lender that guarantees them. So in VHFA's case, they're all serviced by U.S. Bank. That's the bank that offers those loan programs. So because they do that, you can get a lower than market rate, as opposed to if you were to just go and get a regular conventional 30-year fixed rate mortgage through pretty much any lender, you're not going to be able to get the same terms that you can through the VHFA loan programs.
Got it. So it's a supplement.
Correct.
To a lot of the larger loan types that are out there.
That's right.
Okay, so that actually starts to make a lot of sense. And that sort of brings in the piece of talk to a mortgage lender, because they're going to help you walk you through the different things, whereas maybe you don't know if you can afford it, but they can show you the loan types.
Yeah.
So when people are exploring their different options and they're figuring that out, once you move past picking the loan type, what are some of the other things that you're then trying to figure out with them as they find the place they're under contract, and now they're trying to walk through the underwriting process?
So really at that stage, theoretically, the bulk of the eligibility review part is done. You've submitted an application, you've submitted documents, we've addressed any of the items that are question marks about your eligibility, and we've issued a pre-approval. Now, that's an ideal situation. In some cases, there are times when we're issuing pre-approvals that are contingent on something happening. Just this morning, before I drove over here, I issued a pre-approval that was contingent on receiving a remote work letter to carry their current jobs from where they currently live, which is in New York City, to Vermont, because they want to buy a primary residence in Vermont. We had a conversation about it. They said they've done it for other folks, but currently their jobs are not defined as remote work. If we can't define that job as a remote work, then you are now in the position of not having income that can be eligible for a primary residence purchase. If these folks go under contract, we need the remote work letter. And if that's not doable, now the conversation has totally shifted to something else. But let's say we've got all that stuff situated. It's all totally straightforward. If there's updated versions of documents we need, sometimes we got to get a new pay stub or the most recent bank statement or something like that.
It seems to be never ending. For anybody who's actually gone through the process and bought a home, it seems like document. I wanted to ask, are there criterias, like income criterias, that a lot of times people can get knocked out of by making too much money?
Yeah. The VHFA loans are a great example of that. They are income limited programs. You cannot earn over a certain dollar amount annually as a household to qualify for those programs. So that's one of the first things we're looking at when we're screening folks for eligibility for those.
So can I ask, what are your thoughts on that?
Yeah.
So part of the reason I ask is I think back to 10, 15, 20 years ago. I'm in my 20s, and the thought of making six figures, $100,000 a year, seemed like I'm balling at this point. I got 4 cars. I have a couple houses, the family, kids. Everybody's just 2026. 6 figures, $100,000 a year, depending on how your household is funded, can barely seem like you're getting by. So are these programs accounting for that?
Yes, they are now. Even in the last year, pretty much every year these programs update their income limits, they raise them. And so I would say that 1 to 2 years ago, they were still a little bit behind where things were. So it did make it more challenging to qualify. With the most recent update that happened, I believe, in the last year, both to the VHFA programs, and also there are some just conventional loan programs that are income limited that you can receive a break on interest rate if you're below a certain threshold. Those were all raised by a considerable amount. And so it does make it much easier to qualify. VHFA, the maximum household income for the highest income limited program right now is $180,000. It does open it up and make it easier to qualify for them.
Really what it means is that don't presume that your income will knock you out or keep you in, and really just speak to somebody. Another thing I wanted to ask is, I've seen this now on the real estate side, that the programs, specifically that one, the criteria as it relates to the properties is becoming very difficult. And specifically, we've seen this a lot with HOA and condos, that a lot of times they're not underwriting the property. So someone who's not aware of that, or even if it's a real estate agent who's dealing with that, like, why is that happening?
Yeah, so depending on the program, again, just high level, you got all these kind of differing factors between how certain loan programs view certain property types. So again, it's so important just to connect with a mortgage lender, a loan officer that you feel like is giving you good quality information, that's really tailoring things to your specific situation. If you're spending all your time looking at manufactured housing and nobody has ever spoken to you about the requirements for manufactured housing, that's a problem. You need to know what your lender's expectations are going to be for that property to qualify before you even make an offer on that home. Yeah. So that's just high level. Speaking specifically to HOAs and condos, there have been a lot of changes. We're in fact in the middle of active updates by the conventional loan agencies to the requirements for what they call a condo warranty. So again, high level, when a lender is originating a mortgage that is going to be secured by a condo, the conventional loan agencies, Fannie Mae and Freddie Mac, say you have to, along with the loan package, when you sell that loan to us, you've got to include a condo warranty. Now, I'm not on that side of the business. I don't know exactly what that looks like, but effectively what it is lenders saying, it's like a document that says this association checks all the boxes that Fannie Mae and Freddie Mac have outlined as requirements for condo associations. So it is on the lender to ensure that they meet all of those requirements, of which there are many. And those are now being changed. So there are things that are getting easier and things that are getting a little more challenging.
I would say difficult.
One of the things that I would say is getting easier is that one of the things that's looked at with associations is the master insurance policy. Needs to make sure that the insurance coverage is adequate for lender requirements, which for the most part requires that the full replacement cost of the entire association, like all the buildings in the association, is part of the insurance policy, meaning that if the place burns down, the insurance coverage exists to pay for what it would cost to rebuild the whole thing. What used to be a part of that requirement was roofs. The roofs themselves of the associations needed to have full replacement cost coverage as part of the insurance policy as well. What has happened with climate change, increasing environmental impacts of just the world in which we live in, and this is true for all kinds of homeowners insurance, is that coverage cost is increasing, has increased dramatically. So what have associations done? They've just slashed it. Yeah, we could just drop this. We don't need to have 100% replacement cost. We'll do 50% replacement cost. That's fine. Or we'll do something called actual cost. I forget the exact title, but something along the lines of like the actual cost of the roof. So what that means is if the roof gets damaged, right? Let's say there's a tree falls on the roof and damages the association's roof. If it was full replacement cost coverage, the coverage would have to be sufficient to completely rebuild that roof brand new. If it's actual cost, it would take the roof in its current condition and just provide the payout for what the value is of that roof condition it was before it got damaged. So you can see that would come with a lower cost to the association because that coverage is probably going to cost less money. That is an update that went into effect. Actually, I think it went into effect yesterday. That is now allows for associations to have the actual cost coverage instead of full replacement cost for roofs only.
So that means that there was a slightly stricter requirement for the last few months and they've eased that back down.
Correct.
Got it.
Yep.
Because that created a lot of chaos.
Totally.
I know tons of realtors were just like, I don't know why this transaction is not going through, and we're all learning in real time. So that kind of begs the question, from your seat, do you feel like lending is getting a little harder? Because I have realtors, they see so many transactions and you spend a lot of trying to match the scenario and the lending type to the house, and then our goal is always to get to close. But we're seeing, and I've seen, that it's getting harder and the lenders just seem to be asking for information and it's not always smooth sailing. So big picture, not in any one program, But do you feel like it's getting a little tougher, or you just have to work a little bit harder?
I think both. Underwriting guidelines have definitely gotten tighter. Depending on exactly what we're talking about, it's maybe not a huge change, but that goes from everything from borrower eligibility to property condition and property requirements. I think that the way that I have looked at that is an opportunity more than anything. Most of the time, the complaint that people have about lenders is that, why didn't you tell me this sooner? Oftentimes there is a path forward as long as everybody has enough heads up. One of the goals for us is always to be front-running information. Hey, we got this appraisal report in. It hasn't been reviewed by underwriting yet, but we've looked at the report ourselves. We're seeing that this is missing railings on all of the stairs inside the house. We feel that is likely to be flagged by underwriting. We've submitted it in for review. We'll get back to you in a couple days when they confirm. Wanted to just give you a heads up. Maybe a good idea to start having conversations between you and your real estate agent about how you want to handle that request, assuming it's going to come up. I think that we can expect this to keep going in this direction and not in the other direction. I think that we are moving into a world where the powers that be are seeking, for better or for worse, to optimize things for AI to perform a lot of it. And I think that property condition and appraisals are no exception to that. So I think all of this is ultimately in a big effort to standardize things as much as possible so that things can be more streamlined. If there's enough data about a property and there's enough comp data available that is standardized in some way out there, then somebody might go under contract on a property and we don't need an appraisal at all. Because this property, we've got all these metrics that are now all standardized and we can compare it really easily to other properties in the area. And so we don't need an appraiser to actually go to the property. We can use a fully automated thing that's going to give us all the information we need. We've got satellite imagery. Google Truck was just through 3 weeks ago and took an updated curbside photo, right? Now I'm just kind of spinning a little bit into conspiracy theory land. But my point is that I think it's an exaggeration, but I do think that's the direction that things are moving.
There's a bunch of appraisers right now who just got worried for their job.
I think they were worried before I said that, based off the things I've been hearing them talk about as well, with some appraisal changes that came up recently in this last year as well.
Yeah. AI has affected all the business, right?
Yeah.
And it's a weird thing where I'm seeing it's like two things happen that are completely different at the same time. So the clients are coming to us with so much information. They've done their research. They're like, I want to see this property, and they've Googled it and they've ChatGPT'd it, and they have all these things, but it's almost too much. And they still want someone to help them make sense of it. And one thing I always lean back to, especially with real estate, is it's such an emotional decision. And the lenders that I work with, the clients, it's an emotional decision that you want somebody you can trust. You want a team. And that's what a real estate transaction turns out to be, is that you end up accruing this team of usually a mortgage lender to help you with the finance, a realtor to help you with the house and that transaction, and a good attorney to make sure everything goes through and you're protected. And so you need that, and you need these people that you're going to trust. So it's interesting how AI will change that, and I never thought of the amount of data that they're potentially collecting through all these processes. So scary. I'm worried for that now. What can you do?
I don't know. I'm curious what your perspective is on the impact on real estate agents, right? Of course, there's all this conversation about articles. Oh, I just used ChatGPT to sell my house.
Yeah.
But I don't know. I'm skeptical, at least right now. But what do you think?
I think it's exactly what I said, which is it is easier for a client or a customer to aggregate information, and you can pull it, but then you got to verify it. And then you have to look at the nuance and then the actual situation and story, right? And if you think of real estate, the 3 life events that usually trigger the purchase or sale of a home are deeply impactful situations. It's usually some sort of a family status upgrade, whether starting a new family or you're going from your first time you've rented to the first time you're buying. So it's like a life move. It's sometimes the breaking up of a family, right? Divorce is a very big one, and then death. I was on the phone the other day with a realtor who had a very difficult estate situation. Somebody passed away and someone's trying to figure out what to do with this home. And so I think those things are never going to change. And you want somebody you can trust to help you with it because there's just a lot to it. So that's my take. I do think that those in the business have to get better with the tool. That's really what I'm seeing a lot of.
I would agree with that. It's interesting. There's a lot shifting on the lending side when it comes to the integration of AI tools. In some ways, this has been happening already for a long time. Again, before AI became a really big buzzword, there's a lot of features to lending that heavily uses technology. And I think for the kind of thing you're describing and what I described earlier is that distinction between there is a lender with a capital L that can just wire money to people. Sure, that's a function that lenders provide. But then there is the guidance through all of the nuance of what we've been talking about and beyond that at least anytime soon, I don't see a non-human entity being able to provide that kind of function.
Not yet.
I feel a robot Brian can sit in this chair and sound and look exactly like me.
Yeah.
Probably not, right? And so it will change the nature of the work, hopefully for the better. Right? We're onboarding with a tool at Fairway that is a new application and a loan origination software that's all integrated in one that theoretically can do things infinitely faster than what our current platform can do. If I can do that and I can save 30 minutes per client, the lifestyle change for me is going to be astounding. But by the same token, I think moments of high emotion always require other people. And I like your definition and pointing out that real estate transactions tend to coincide with big personal, emotional life events. I saw in your notes you flagged that I'm a theater kid, so I'm going to tie it into theater right now. I was
going to ask about social media, so now...
I'm going to tie it right into it for you. Oh. I have always been struck that the theater has endured through all of the technological advances in our world, right? TV is infinitely more convenient than even going to the movie theater, but we still do it. And we still do it, I think, because we want to be in the same room as other people at the end of the day.
That's what COVID showed us.
Yep,
if you really think about it, we all got secluded. The home buying process during COVID was you couldn't even see the house. But yes, that ability to deal and be with people is hugely important. And that's why when I look at the real estate industry in general, people want to see the house and connect and talk to you. And the more information we get, it's almost like that need is more. And I think it was like 87-90% of people still want a realtor, which means they probably still want a mortgage. I also see the difference in transactions from our seat when people are quote unquote working with online entities for mortgage lending that they don't really have they can't pick up the phone and easily call versus someone they can actually just go see or they can talk to. And there is at times a preference for having some sort of local institution. But kind of going back, there was one thing that I always try to ask any lender, which is we're seeing a lot more people do, in line with AI, unorthodox kind of work, right? Not just your typical W-2. Sometimes people need side hustles. And when you're in those situations, especially trades, self-employment, your own businesses, stuff like that, like a lot of these are not typical W-2 jobs. A lot of times these people have money. They have money in the bank. I've had scenarios where someone's like, yeah, we're cash flowing $200,000 a month. I can't buy a house. What do you do in those scenarios?
Fortunately, there are loan programs that exist specifically for these purposes. Not every lender offers them. There are situations in which you may be working with somebody and they just tell you don't qualify. I would encourage folks who maybe are kind of fit some of the descriptions you provided to ask your real estate agent, ask other people who else there is to talk to, because there are other options available. So as an example, your self-employed person who claims a bunch of deductions on their taxes, right? Could be fully legitimate deductions, actual expenses, but their gross monthly income is $200,000 a month. But their lender says they can qualify for a $100,000 mortgage because they have a whole bunch of write-offs, so it shows that they earn $30,000 a year, right? It's a really classic situation. There are programs that are designed to look at income in a different way. They're called alternative income loan programs. There's a couple different types: 1099 loans, bank statement loans, P&L loans. As all those names suggest, it's different sources of verifying what the income actually is. To take a bank statement loan as an example, we don't look at tax returns at all. We get 12 to 24 months history of bank statements showing the business deposits. Just the business deposits, the income coming into the business from services performed. We then come up with a monthly average based off those deposits over that time frame. And then depending on the specifics of that business, how many employees do you have? Are you a service business, or do you produce goods? Do you have a cost of goods? There's some specifics that we need to suss out. A haircut gets applied to whatever that monthly average is, right? If you have no employees and you are a service-related business, so you don't really have any cost of goods, that haircut's going to be relatively small. Usually it's 10 to 15% cut off of that.
Okay.
If there's more expenses, then you account for that by 30, 40, 50% cut off of that. What remains is the qualifying monthly income. We've had people where that is the difference, right? You go from $3,000 a month in qualifying income to $25,000 a month in qualifying income. Totally changes what your eligibility is when it comes to being able to get a mortgage on a house.
So really, again, for the people out there or anybody listening who may typically think, you know what, it's hard for me to do that because I don't have the regular income. Again, there are programs. All right. So I want to shift. I got a couple more questions for you. You are not originally from Vermont. Came here, been here 5 years. And I always like to ask guests, because I kind of feel like when I get into my policy section, the affordability, staying in Vermont, it's hard and stuff, but then you find people that really like Vermont and want to make it work. So what makes you and the family stay here and try to make it better for Vermonters? Because there's something that pulls about Vermont.
Moving to Vermont we pegged it down to several states. Vermont specifically came about because it was the first place that I got offered a job, but we knew we wanted to move to a place that was maybe somewhat similar in vibe to Vermont. But Vermont in particular felt, as we were looking at options, it did feel like the best fit. I think that there is a combination of politics and lifestyle and opportunities for our kids in terms of their education, and also just purely the landscape, the geographical location and what it feels like to be here and to move around in this space, and the access to places like forests and mountains and lakes and rivers coming from the center of the United States. Those things are, you got to travel further to get access to those things. But even just like looking out my window in the morning is a different emotional experience. You said home buying is so emotional. It's very emotional. It's the space that we live. It's how we define our day to day. It is a very different experience than looking out my window on the cornfields of Iowa, right? That's just a different vibe, and this is what we wanted. It is a more expensive place to live. Undoubtedly, I think Iowa has some of the lowest cost of living in the entire United States. So by comparison, there were some things we knew, but there were some things that were a bit of a shock. There's no question that we would stay here. The things that stand out to me as being the biggest reasons to stay, one I've already said, it's the landscape. The feeling of moving around Vermont is very hard to describe if you've not come and experienced it.
There's something that kind of calls you. It's the mountains. It's just a space. There's something about wherever you drive, trees, like it's a very different experience.
If you listen to Noah Kahan, the feeling you get listening to his songs captures a lot of the energy for me. I think he has other songs that are better at capturing this, but the mist-covered mountains is a real thing, man. That feeling is real. And there's very little that I could compare the experience of being here at peak foliage season to. It's unbelievable. It's a very magical sensation. So that's number one. Number two, the people are wonderful. The spirit of Vermonters is really amazing. Vermont is a more purple state than people realize.
Really?
I think it's known for its left politics, Bernie Sanders, of course. And of course, that is true of many places. But especially as you get further out, and Vermont is also one of the most rural states in the United States that I think people don't really realize. It goes in all different directions, but I do think that there's a strain of quality to Vermonters. Vermonters being a non-native Vermonter, I know I'll get flack for that, but I feel like I observe among people that are from here that is shared, regardless of political affiliation, a kind of skepticism of the big guy and a preference for local. And they will go to extreme ends to support each other and support local. That is unique among the states in New England. That is unique, certainly in my experience living in the Midwest. I've never experienced that kind of community before. And don't get me wrong, people can get at each other. There's a lot of conversation about what direction people want the state to go in and certain parts of the state to go in. But I think that's a shared value that I really appreciate and I have not found elsewhere.
So I serve in the Air Force. We're a tiny state, like 650,000 people. Mm-hmm. There's only one air base in the state, and it's supported pretty much universally, regardless of politics. Wherever they go, they are so well respected because it's made up of Vermonters, and Vermonters they have that thing, but they're just going to figure it out. We're going to do more with less, and we're going to help each other. So that's a really true thing you said. Oh, I like that. All right, I got one last question that I needed to ask. So you do a lot of videos on social media, and my question is, how did that start? And that's just a space that things exist nowadays. Do you approach it as just another form of just putting yourself out there, and is it just one way, I'm just giving information, or is it that just a theater coming out and you're like, now I have a camera and a phone and a stand and now I can do it?
I do think a lot of it is that. I think that I have an itch to be creative that does fulfill. And so, yes, totally part of it is purely selfish. I gotta just get some energy out of me. But the reason I started doing videos on Instagram, in my head, it was going to be the way that I was going to connect direct to consumer, right? 2/3 of our business is real estate agent referrals. That's pretty normal for mortgage lenders, but I was like, I want to try to build sort of another funnel of business. So I'm going to get on Instagram. And of course, that's not at all what happened when I started doing it. But what did happen is real estate agents that I knew or didn't know would start to follow me. And then I would start to have exchanges with them on Instagram that I just never would have had, right? Maybe if I called them every week, which I know some mortgage lenders do, and I absolutely despise doing that, I wouldn't have had these interactions with folks. And so it actually wound up turning into a platform where I was able to really make some new relationships or just kind of help support some existing relationships and really get to know people more personally in a way that I wouldn't have otherwise. So that became the major function of the tool. Most recently, I have been making Vermont lifestyle videos. I've only done a handful of them. They are far and away the most successful videos I've put on Instagram, with many more views and much more engagement. And it's interesting because I have thought for a long time that at the end of the day, what any one of us is selling, you or me, in a real estate transaction, it's not a mortgage. I'm not selling money to people. That is what I do. It's the tool I provide. What somebody is buying in a real estate transaction is they're buying a lifestyle. That's what the purchase is. And having had that realization, I have thought for a while that actually the pathway into getting people to pay more attention to me as a mortgage lender may be to make more videos about lifestyle, at least on a platform like Instagram. I've not done this long enough yet to know if that theory is going to bear out, but I can tell you that I've had more people reach out to me about mortgage lending services in response to those videos than anybody has ever done in response to the mortgage specific videos that I have made. And I've been doing this for a couple of years, semi-consistently on and off in that time period. But there's a lot of mortgage videos out there that I didn't get anybody reaching out saying, hey, I want to use you as my mortgage lender as a result. And so I think there's something there. And so I do think that ultimately it could be a direct-to-consumer thing.
I think actually a lot of it has to do with the fact that, so it's not a dissimilar thing. Like I explain this to new agents. I say, we're not buying the house and we're not actually selling it. It's a seller's house and the buyer's buying it. I said, what we are is we are sort of that bridge, and we're helping broker the deal so that both sides, whatever side we're helping, is protected and it works and it goes through. And ultimately we're selling ourselves and our ability to help somebody with that. So it would make sense then in the same way that you're not selling a loan, but you're helping. And so people, if they connect with you, they're going to be like, that's the person I want to help me.
Yeah.
So, well, whatever it is, it's working. And hopefully today helps add to that. Is there anything else that you wanted to quickly add?
I think that kind of covers it. Yeah, thanks so much for having me. This is a blast. I love doing this stuff.
I find it nice to be able to actually talk through things, because sound bites are great, but you also want to go back and say, yeah, all right, now I understand something. I learned something. Yeah. So, Brian, appreciate you coming on.
Thank you so much.
It was a blast.
Appreciate it.
And hopefully next year you can come back and do it again.
Absolutely.
Awesome.